How do you select your investments? Are you looking for a strategy that requires minimal intervention and yields high returns? Today we're introducing a fascinating book that might just change the way you think about investing. The book is Coffee Can Investing by Saurabh Mukherjea, an Indian author known for his insightful perspectives on finance and investment. The book introduces us to a unique and intriguing investment strategy, one that goes against the typical fast-paced, high-intervention approach that we often associate with the stock market. This strategy is called Coffee Can Investing. The name Coffee Can Investing harks back to the olden days in the American West. Back then, people would put their valuable possessions in a coffee can and bury it in their backyard for safekeeping. Over time, these items would appreciate in value, a slow but steady increase, unaffected by the daily fluctuations of the world around them. In a similar vein, Coffee Can Investing is about identifying high-quality businesses, buying their stocks, and then sitting tight. It's about resisting the temptation to constantly buy and sell, to second-guess the market, to react to every little fluctuation. It's about having faith in the intrinsic value of good businesses and giving them the time they need to grow and prosper. Imagine a garden where you've planted seeds of various plants. You wouldn't dig up the seeds every day to check if they're growing, would you? Instead, you water them, ensure they get enough sunlight, and then patiently wait for them to sprout and grow. Coffee Can Investing works on the same principle. It's about nurturing your investments over a long period and reaping the benefits of compound interest. So if you're tired of the nerve-wracking roller coaster ride of traditional investing, Coffee Can Investing might just be the strategy you're looking for. It's a strategy that demands patience and discipline, but the potential rewards can be significant. Now, let's delve into the details and unravel the secrets of Coffee Can Investing. What's the philosophy behind Coffee Can Investing? A good question indeed. Picture this. You're a pioneer in the Wild West. You've got a precious hoard of gold coins, and you want to keep them safe. So you bury them in a coffee can in your backyard. You're not going to dig them up every week to check if they're still gold. No, you let them sit, knowing their value will endure. That, my friends, is the essence of Coffee Can Investing. You see, this style of investing doesn't chase the quick dollar. It's not about the adrenaline rush of buying and selling in response to the market's whims. Instead, it's about recognizing the potential for long-term growth in a company and having the patience and discipline to let that growth happen. It's about finding those gold coins and then leaving them alone. Because here's the thing. The market is a tumultuous sea, full of waves and storms that can shift prices dramatically. But beneath that surface chaos, the tides of true value move more slowly. They're driven by the fundamental strengths of a company, its ability to generate profits, its competitive position, its leadership. These are the things that, given time, will reflect in the company's stock price. So, in Coffee Can Investing, we're not day traders. We're not even really investors in the traditional sense. We're more like business owners. We buy into a company with the belief that it has the ingredients to succeed over the long haul, and then we give it the time to prove us right. This approach requires patience, yes, but it also requires discipline. The discipline to resist the urge to react to every market blip. The discipline to stick to your guns, even when others are losing their heads. Because in the long run, it's the tortoise, not the hare, that wins the race. So patience and discipline are your friends in Coffee Can Investing. But how do we identify these high-quality businesses? Well, that's a tale for our next scene. Stay tuned. How do we sift through the noise and identify high-quality businesses worth investing in? This question is pivotal to successful Coffee Can Investing, and Saurabh Mukherjea provides us with some invaluable insights in his book. According to him, there are two key metrics that form the backbone of this investment strategy: return on capital employed, ROCE, and revenue growth. Let's start with ROCE. This is a financial metric that measures a company's profitability and the efficiency with which its capital is employed. In simple terms, it tells us how well a company is using its money to generate profits. High ROCE values are a strong indicator of a high-quality business. Companies with a ROCE of 15% or more for 10 consecutive years are considered particularly promising, but why is this metric so important? Well, a high ROCE suggests that a company is efficiently using its capital to generate returns, indicating good management and a strong business model. It's like having a high-powered engine in a car. The better the engine, the smoother and more efficient the ride. Now, let's move on to revenue growth. This is another key indicator of a high-quality business. Saurabh Mukherjea suggests looking for businesses that have shown a revenue growth of 10% or more for 10 consecutive years. This consistent increase in revenue indicates that the company's products or services are in high demand. Think of it like this. A company that's consistently growing its revenue is like a popular restaurant that's always full. The demand for its offerings is high, and it's likely to continue doing well in the future. By using these two metrics, ROAS and revenue growth, we can filter out the noise and find businesses that are not only profitable and efficient, but also in high demand. These are the kind of businesses that make for good long-term investments, the kind that can fill our coffee can with golden beans. Now that we know what to look for, it's time to apply these principles. Let's look at a practical example of coffee can investing. Consider the case of Page Industries, a licensed manufacturer of Jockey International and Speedo in India. When Saurabh Mukherjea first analyzed this company back in 2009, it was quickly evident that Page Industries was a perfect candidate for a coffee can portfolio. Here's why. The company had been delivering a return on capital employed of more than 15% consistently for the previous 5 years. Not just that, the revenue growth was also more than 10% each year. These were strong indicators of a high-quality business as per the coffee can investing philosophy. Page Industries also had a robust business model. It was operating in the underpenetrated and fast-growing innerwear market in India and had a strong brand in Jockey, which gave it pricing power. This was a classic situation of a good business available at a reasonable price. So, if an investor had put their money in Page Industries in 2009 and decided to simply forget it like a coffee can, what would have happened? Well, by the end of 2019, their investment would have grown by an astounding 50 times. Yes, that's right, 50 times. This example illustrates the power of coffee can investing. It's about identifying high-quality businesses, investing in them, and then having the patience to let the investment grow over a long period of time. It's not about timing the market or constantly churning your portfolio. It's about the power of compounding, the eighth wonder of the world, as Einstein famously said. However, investing is not always a bed of roses. There are times when things don't go as planned, and that's where risk management comes into play. But what happens when things go wrong? Let's discuss risk management. Investing is not without risks. How does coffee can investing approach this? Well, the concept of coffee can investing embraces the reality of the investment world, acknowledging that risk is an inherent part of the game. But the beauty of this approach is that it has a unique way of managing these risks. One of the primary ways coffee can investing mitigates risk is through portfolio diversification. A diversified portfolio is like a well-balanced diet. Just as you wouldn't consume only one type of food, you shouldn't put all your financial eggs in one basket. By spreading your investments across a variety of high-quality businesses, you cushion yourself against the volatility of the market. If one sector or company experiences a downturn, the others can compensate, helping maintain the overall health of your portfolio. However, diversification isn't a one-and-done deal. It's not about buying a bunch of stocks and forgetting about them. Coffee can investing champions the cause of regular reviews. This means keeping a keen eye on your chosen companies, assessing their performance, and ensuring they continue to meet the criteria of high-quality businesses. Remember, while the coffee can approach encourages long-term holding, it doesn't advocate for blind loyalty. If a company no longer meets the criteria, it's time to part ways and replace it with another that does. So, the name of the game here is patience and discipline. Patience to let your investments grow over a long period, and discipline to regularly review and adjust your portfolio as necessary. It's about understanding that the market will have its ups and downs, but sticking to your plan nonetheless. Risk management in coffee. Can investing isn't about eliminating risks altogether. That's an impossible task. Instead, it's about understanding these risks, planning for them, and using strategies like diversification and regular reviews to mitigate them. With patience, discipline, and effective risk management, coffee can. Investing can be a game changer in your investment journey.